Picture this. You're staring at your bank statement, and there is actually money left over after paying your bills. You have a critical choice to make, and your extra cash can only travel down one of two distinct paths. Do you aggressively attack your debts, or do you invest it to build wealth while you sleep? Let's establish the extreme red zone, where the math is undisputed. If you are carrying a balance on a credit card charging 22% interest, paying that off yields a guaranteed, risk-free 22% return on your money. You might hear an amateur stock picker brag about their portfolio, but the truth is that nobody, not even the most elite investors on the planet, can consistently beat a 22% credit card interest rate safely in the open market. The stock market is chaotic in the short term. Some years it surges 30%, other years it drops by almost 40%. But over very long timelines, it has historically averaged an annual return of around 10%. This chart lays out the central mathematical dilemma. If you have a debt charging a conservative 5% interest rate, and you could potentially earn 10% by investing your extra cash, the decision seems obvious. You invest the money and pocket the 5% difference. If we lived in a perfect mathematical vacuum, that logic holds up every time. You would always invest the difference. But the real world is messy, and a series of hidden variables warps this equation. Here, we are looking at a standard real-world test case for what many call good debt. You have a $350,000 mortgage locked in at 4% interest over 30 years. Your monthly payment sits at $1,670, and you've managed to scrape together an extra $1,000 a month to deploy. If you choose the debt avalanche path and attack that mortgage with the extra $1,000 every month, you will be mortgage-free in about 14 and a half years. You cut your debt timeline in half and save yourself roughly $140,000 in interest. Now let's test the opposing math. You pay only the minimum on the mortgage and invest that extra $1,000 monthly from day one. Over 30 years, that investment account grows to roughly $2.2 million. Even after subtracting the mortgage interest you paid, you walk away with about $1.9 million in total wealth. That is an $800,000 advantage simply by ignoring the debt. The primary driver behind that massive gap is our first hidden variable, inflation. Over a 30-year timeline, inflation makes food, gas, and consumer goods more expensive, but your fixed-rate mortgage payment stays exactly the same. Think about what you paid for a cup of coffee 10 years ago versus today. In 15 years, you will still be making that $1,670 mortgage payment, but you'll be paying it with money that is worth less than it is right now. You are essentially paying off the loan with monopoly money. Meanwhile, the assets you invest in tend to keep pace with or exceed inflation over those decades. During inflationary periods, a low-interest, fixed-rate debt stops being a financial burden. It acts as a strategic asset that you are essentially being paid to keep. The math gets more complicated when you add the second variable, taxes. Mortgage interest is often tax-deductible, meaning the government subsidizes part of your housing cost, which artificially lowers your effective interest rate. At the same time, when you sell your investments, capital gains taxes quietly eat away at that projected 10% market return. There is exactly one scenario where the tax code provides a clean, undisputed win. If your employer offers a 401k match, contributing enough to get that full match is free, pre-tax money. Turning down a guaranteed 50 or 100% immediate return mathematically invalidates any aggressive debt payoff plan. This graph illustrates our third variable, asset depreciation. Mortgages are tied to houses, which generally appreciate. Car loans, hovering between 4 and 8% interest, are tied to hunks of metal that lose value the moment you drive them. When you throw extra cash at a depreciating asset, you are paying a premium to own a dropping rock. Letting a moderate interest car loan run its normal course, while your extra cash grows in appreciating assets, is almost always the stronger mathematical move. But none of these calculations matter without the foundational prerequisite, the emergency fund. Before you debate paying off a car or buying index funds, you must have 3 to 6 months of living expenses sitting in a highly liquid, incredibly boring savings account. Without liquid cash, a sudden medical bill or an unexpected job loss triggers a domino effect. You will be forced to sell off your investments during a market dip or take out high-interest credit card debt just to survive. Lack of liquidity will collapse your entire wealth-building strategy overnight. All of this complex math assumes you are a rational robot with a fixed timeline, but human psychology and age alter your risk tolerance. A 25-year-old has decades to recover from a market crash and can afford to chase higher returns. A 55-year-old nearing retirement needs stability over maximum growth. Spreadsheets assume perfect, emotionless execution over 30 years. They don't account for the fact that when the market drops 30% and the news cycle is screaming about a recession, most human beings abandon their investments and panic sell at the exact wrong time. This validates the natural debt hater. Some people simply cannot sleep peacefully with a balance hanging over their heads. Eliminating debt secures a guaranteed return, but more importantly, it provides a psychological dividend, peace of mind, that cannot be plotted on a graph. This brings us to a highly effective middle ground. You do not have to choose an extreme. You can take your extra cash at the end of the month and split it 50-50, directing half toward reducing your debt and half toward market investments. Splitting your money guarantees you leave some potential wealth on the table compared to going all in on the mathematically optimal choice. But it successfully hedges your risk, ensures you are building assets, and protects you against emotional burnout when the market inevitably swings. Ultimately, deciding between debt and investing is not a universal math equation. It is a highly personal risk management strategy. Evaluate your interest rates, check your emotional tolerance, pick a path, and execute. The only wrong choice is spending so much time searching for the perfect mathematical answer that you never actually make a move.